So, but before we get into what is happening with the U.S., we want to look at, well, everyone keeps talking about it, especially when you think about the Fed and the fact that, Powell came out and said today, if inflation continues to go up, we're going to have to get more aggressive. And other Fed governors are saying, if things continue to rally, then we can get more aggressive and increase at a faster rate. Well, it's like, well, what's if? Like everyone keeps talking about this if. We're already at over 7%. And because of all of the current events of the world, it's not peaking. And if you look at these estimates, the estimates keep getting pushed out on when do we peak? When do we continue? So, the actuals continue to go up in a scenario where WTI rises to $1.20 in March. Well, what about dated Brent at over 118? WTI doesn't have to get there to see these disconnects in the amount of crude. And this is, again, a very good chart showing things, but it's important to appreciate that the quality of the crude, the availability of the crude is so important when you're looking at some of these shifts. And when you look at where these prices go and how this is going to impact things, diesel prices are still going up. Even if you have oil going from 110 to, let's call this the Bloomberg economic baseline of $95, it doesn't mean diesel comes down. It just, there's a lot of reasons why diesel could stay higher. And a lot of these pieces, this is also just looking at pricing. Well, what happens with grains? What happens with, corn and wheat and these other pieces that continue to send things higher? Little anecdotal story, but my wife went to go get, so there's a place by us that sells they have a bagel deal. So it's a dozen bagels, half off on Wednesdays. So she goes, she gets she normally gets them. The kids eat them through the week and then on the weekend. She went today and they not only got rid of the deal, but they increased the price of a dozen by $3. So just to give you an idea of where some of these shifts are, and again, this is just one example that I'm just using, but think about a $3 increase on a pretty much a $12 amount. You're talking about real percentages, and it's increasing exponentially at all levels, not just at the pump. It's because diesel touches everything, and that's why we focus so much about it in the EIA show, because that's where you see these prices continuing to go up. So when you look at where the estimates, this is coming from Bloomberg Economics, with the current energy price spike headline, CPI may exceed 8% in February before falling to 5% by the end of the year. Scenarios in which oil prices surge further to a 120. So my view is, in terms of where things are, is that in a given, you have comps getting a bit harder, but you're going to get more along the lines of a stagflation. You're going to get more of this shift and not so much a drop, but things just remaining elevated as you have wages that are looking to keep pace, which is why when you look at Powell and the pressures he's under right now is, you need to make sure that you control rates, that you don't have a wage price spiral. But what's happening with Russia-Ukraine is making a quote-unquote soft landing very hard to achieve because of the multiple knock-on effects. Now you have new legislation that's going to officially ban, or at least create something. Manchin is working on it to ban Russian oil imports, which, as we've said, is already happening when you look at not sanctions, but what companies and corporations are doing. Now, Russia suspends parts of rules on saving oil revenue and reserves. They've also reduced the amount of cash that banks have to keep on hand. They're trying to do things to maintain as normal as possible activity within the country itself. But all the while, what is happening with inflation, euro inflation swaps, USD inflation swaps, moving close to, if not at new all-time highs, especially in Europe. There's going to be a lot of additional pressure with this going up, especially as we get new readings and some of these new growth components, which again is going to put additional pressure on what the Fed has to do. Now, to be clear, for all of those that follow me and have watched us religiously, I never believed that 50 basis points was going to happen in March. I've said from the beginning it was 25 basis points. I still hold to 25 basis points. And I would be shocked if we got 50, to be clear. So I think it is 25, and he's going to be very consistent. But I do think they take a bit more of a hawkish stance on quantitative tightening and how quickly they could continue to do it. I've thought from the beginning, and by beginning I mean from February of last year, we were going to get 3 25 basis point increases over three meetings back to back to back. So now when we look at where some of the things are on the 10-year, so you had a huge shift where the 10-year dropped, and you had the 10-year inflation rate break even going back to about 2.7% as you had the 10-year coming all the way down. And this was more of like a risk off, where people were rushing to buy the 10-year. But now you're starting to get a little bit of that walk back and some of these adjustments as you're getting a little bit of a bounce. And I think that's going to come down to what activity happens at the 10-year, because this is the one to watch for emerging markets, which are already under pressure, which are already struggling. And this is only going to be something a bit different. So when you look at the spread from selling the 2-year and buying the 10-year, so if you sell the 2-year, and remember, prices that go, the price and yield are inverse. So as prices go down, yield goes up. And as prices go down, up, yield goes down. So here you see the flattening of the yield curve between the 2 and 10, which is a very important one to watch. And you can see that every time we've gotten to 0, where it's essentially par, is to the end of 2016 into 2017, the end of the middle of 2019. And then you had this big explosion. And that's when you look at what really sparked some of these recessions. And as you look at this is going to be a concern and something to watch as a potential tell for where some of this fear is and how that's going to pivot and really react with the yield curve itself. So now when you start looking at what is happening with the ISM and where things are going, so the red line is the ISM manufacturing PMI. Obviously, it's come down, but where are sales? Where's sales growth? And that's when you look at where ISM is typically a bit of a leading indicator for sales growth. And that's, again, leading back to what we've been saying with some of these issues. Now, the ISM was a little elevated given some of the issues on supply chain, which some of it has come back. But we do expect this movement down on sales growth, and it's going to be driven by price. It's there. I can't stress that enough when you look at where inflation is. So now when you look at U.S. headline CPI inflation, where those forecasts are, and the implied base effect, assuming CPI price level unchanged from January 2022, here's where another expectation that you get a very quick drop to about 4%. And that's, again, something where I think it remains north of 5% as things remain elevated, as we get different shifts and different problems, because Russia-Ukraine isn't ending anytime soon. The two sides are meeting again. Apparently a ceasefire is on the table, but that's good and bad, because if you have a ceasefire, that also enables Russia to have their supply chain catch up. And at the same time, it enables the Ukrainians to dig in to get more supplies, more equipment. So it goes both ways, but one of the biggest issues right now is the supply chain for Russia that is impacting their ability. So is that something that would be actually a good or bad thing from a strategy standpoint? Now, when you look at the headline, the reason why I say that is because this isn't going away tomorrow. And even if it did, there's so many things that would have to be unwound, and there's already so many detrimental pieces to infrastructure there, and it's so tied to the underlying basic living conditions that's going to make this drop off a bit harder to achieve. So then when you look at the tightening, it brings an array of consequences. And one of the things is zombie corporations need cheap debt. So as your weighted off average cost of capital, or WACC, starts to go up, what does that do where you're not generating revenue? You have to borrow more, and the cost of borrowing is going up. So as you roll debt, it gets more expensive. This creates, again, these knock-on effects that aren't going to go away, which is going to become a much bigger issue for not only just the U.S., but also other nations. Now, when you look at the U.S. trade balance, U.S. goods trade deficit surged to new record in January to $107.6 billion versus the estimate of $99.3 billion. The value of imports increased 1.7%, led by motor vehicles, capital equipment, and industrial supplies. We import everything. We've been exporting our supply chain for decades, and now we're importing inflation, which is why I talk so much about emerging markets and where these costs are going to come from, because what's happening in Europe, we're going to import it. And that's going to continue to show up and put pressure on where we are. So then when you look at the goods spendings, U.S. goods spending as a percent of PCE, before the pandemic, goods comprised 31% of consumption. The share has spiked to 35%, which is consistent with 2006 levels, effectively reversing nearly 15 years of a trend in just 2 years. So this is just looking at underlying price and the amount that is being spent. Just because costs have gone up, you've had this big reversal in price, which again is going to lead to a more underlying issues for the consumer. So then when we start looking at the Atlanta Fed wage growth tracker, median wage growth, here you have that big surge, but yet the consumer confidence is going the wrong direction. So why are you getting this bifurcation? So a serious divergence forming between wage growth and expectations for income over the next 6 months. So the expectations for income over the next 6 months is going down while actual wage growth is going up. And it's really a factor of how far is that money going, because people are not looking at this and saying, oh, well, I got a raise, so this is good. They're looking at it saying, I got a raise, but it still didn't meet my increased cost of living. And that's where you're getting a lot of these knock-on effects, which is keeping some of the sentiment under pressure, which I think is going to pull down some of that in general. So personal income growth was flat in January. The expectation was for negative 0.3%. Spending was at 2.1% versus the estimate of 1.6%. And again, so you're starting to see some of this mix, but then let's put some data behind it. So real personal income ex government transfers has now contracted for 2 consecutive months, which hasn't happened since the beginning of 2021 and before that initial phase of the pandemic. So that's another issue in terms of when you're looking at where things are, when you back out government transfers. So without the government transfers, you're falling. You're not keeping pace on the wage side. So it's just another, when you start peeling back that onion and looking at, well, income looks okay, but what does that mean? How far is that money going to go? What happens when you're relying more on savings? So then when you look at government transfers, here you can see that government transfers fell again, still at an elevated level, but down, it's at 18% of personal income, down from the peak of 33%. So what happens if we have to tighten our belts a little bit because costs get out of control and the government has to pull back some of this debt? Well, this will go lower, which will then again push this down even further and becomes an underlying pressure point. Then you look at savings rate. Savings rate has collapsed to 6.4%, which is the lowest since 2013. So this is essentially saying that people can no longer take their excess, because there's less excess in your paycheck, to put it into savings. Again, another underlying pressure point, another issue as prices continue to ratchet higher. This is something where there's not going to be enough to come out of savings. Then when you look at U.S. personal consumption expenditures, well above their normal rate. But then when you chain it and look at real personal consumption, it's right in line, still a good number, but you're getting an idea of just how much that inflation is going up when you look at the deviation from trend and then the real staying right on trend. But as we get these pressures that we keep highlighting, we expect this to continue to roll over and become a bigger hindrance to growth. But with that being said, a positive side, the U.S. 1 year ahead spending median expectations of all consumers, there's still the expectation of this pent-up demand. The income of the pent-up demand, though, is weighted towards the lowest common denominator. So now mind you, this was all done before you had the Ukraine-Russian situation. So how much of that takes away what the pent-up demand is, because they're going to have their earnings eaten into? And that's one of the biggest components of, can wages continue to rally up as prices continue, as there's now a bigger issue for cost and what the companies can actually pass on, and that becomes an underlying problem. So then when you look at PCE inflation, hotter at 6.1% versus 6%, which is the headline rising at the fastest rate since February of 1982, core PCE at 5.2%. And again, as you're seeing, you're getting these pressure points. And this was, again, all before an invasion of Ukraine. So then when we take that and you look at the misery index and the consumer confidence, that's where you continue to see this pressure. And as you have inflation now ratcheting up again, this is again going to push things and keep things under pressure. But durable goods orders were stronger in January, which is a net positive. You had an increase of 1.6% versus the estimate of 1%. And core orders were up 0.7% versus the estimate of 0.4%. So this is a net positive for where things are. But we also want to look at, well, where are some of the other barometers? So Chicago PMI, which we'll talk about more in a minute, when you look at, there was a big drop in Chicago PMI of 56.3 versus the expectation of 62.3, and it's the largest 1 month drop. Chicago PMI dropped in Feb, so a headline now at the lowest since August 2020, pulled down by slower increases in new orders, inventories, and production. Prices paid rose at a slower pace. Employment, unfortunately, remains in contraction. So this is where typically you can see that the Chicago is usually a leading indicator for where ISM is. So it just shows that there could be a little bit of pressure coming up, which again is going to just weigh on some of that misery index. So then when you look at the ISM, they came in slightly better than expectations. February came in at 58.6 versus the estimate of 58. New orders surged to 61.7 versus 57.9. That is a big positive and a good leading indicator. Prices paid ticked down but stayed fairly flat at 75.6 versus 76.1. Inventories, production, supplier deliveries all up. Unfortunately, backlogs rose and employment ticked down. So you had employment ticking down, which is a problem as you have backlogs increasing, which again, you're starting to see another creep higher in supply chain issues, which is going to put an additional weight on where things are. New orders versus production spread in ISM manufacturing ticked back up in February, underscores some stress, but level is not back to territory where supply chains were rupturing. But you're coming back to a stress point. And even though they're not surging back up and collapsing, you're still at a real point of concern. So then when we start looking at the underlyings, this is looking at the backlog coming back to the highs, and if you look back through history, it's the highest ever outside of when we were at extremes. New orders, though, ticked back up, not back to the highs, but again, that's a net positive in terms of where some of that growth is. And then when you look at ISM manufacturing prices paid, as we were saying, we expect this to stay sideways and remain an overhang when you look at the drivers for inflation, because prices paid, what are they paying? What is their risk? And then how much of that can actually be passed on? Now, in the next segment, we're going to go deeper into what are some of the regional pieces saying, and what does that mean for not only the consumer, but also inflation, and how is that going to kind of lead into what's going to happen in March and for the pretty much the whole of Q1.